Hello everyone, my name is Josiah Willis and I'm a real estate agent with Caliber Real Estate here in Bellevue. I'm also CEO of Pro Estate Planning here in Bellevue, but today on Ask the Experts, I'm going to be introducing and interviewing Brian Evans, an accomplished CPA, Certified Public Accountant, and also personal financial specialist. Brian has a lot of history in this space, so we're going to glean from his knowledge today, and we're going to talk through different questions as it relates to real estate investing, but also in estate planning and retirement planning. So Brian's actually written a few books. One that's more pertaining to today's topic it's called The Complete Book of Retirement Strategies for Everyday Life. Brian, you also have your own radio show, is that correct?
Yeah, I've had about 6 years on 570 KVI and 770 KTTH. It's an hour long on Saturdays, and you can get them on our website too, and I'm on all the podcast areas too, so
Nice.
You can get them on the MadronaFinancial.com website.
That's awesome. That's right. I forgot to mention he's from Madrona Financial Services. He's got an Everett and a Bellevue office, but he also travels the country teaching other people about a special investment vehicle that we're going to talk about later today. So make sure you stay till the end. But during this about 30-minute interview, we're going to be talking about retirement planning, like I mentioned, and real estate investing. So stay tuned. Put your phones away, turn off Facebook, grab pen and paper, and pay attention because you might be able to learn some nice strategies for retirement. So let's get started, though. Can you tell us a little bit about yourself besides what you've already shared, and then
Yeah, I've been a CPA for 35 years, and I have about 30 employees in the Puget Sound area, Everett and Bellevue primarily. I started the investment advisory firm 20 years ago and manage about $400 million now.
Wow.
About $100 million in passive real estate that we're going to be talking about, $100 million in annuities, another couple $100 million in stocks, bonds, and alternatives too. And then I'm also an estate planner, trust planning, do it all, a one-stop shop.
Wow.
On all of this stuff. The things I don't do is list real estate for sale. I'm not a bank, and I'm not an attorney. So, but
Nice.
pretty much the rest of it I can do.
That's awesome. And oftentimes a lot of CPAs don't really get into the financial planning side of things, right? It's more just tax savings and stuff.
Yeah, you have to be licensed as a financial planner to even talk about it. So it can be a little dangerous if you're just kind of dabbling in it. You kind of have to have a really thorough understanding. And so it's helped being hired as a national coach to other owners of financial advisory firms because there's a lot of stuff they can't talk about because very few of them are CPAs. And so I've been able to kind of put those two worlds together and have a number of advisors at my firm that can do that also.
That's awesome. Awesome. Well, let's get started. We're going to start kind of talking through these questions. But the biggest thing is I kind of separated out the questioning between real estate investment for those of you who either hold real estate holdings in your portfolio or who are interested in doing so. And then the second half of the questions are going to be more geared towards estate planning and retirement planning. All right, so let's get started. So can you share with our audience who may have real estate holdings, like I mentioned, or maybe interested in investing in real estate, what real estate affords investors in terms of tax saving strategies versus alternative investing?
Yeah, what's interesting about real estate, first for me though, is I often do seminars and I ask people, okay, where did you make your money? And it's always two places, their business or profession and real estate. But then they go to their financial advisor, and their financial advisor says, buy stocks and bonds. And they say, well, I didn't get rich by investing in bonds. I don't get that. So real estate's been huge for many of my clients that have money and need a CPA and a financial advisor. Really, real estate was a key component of that. There certainly are tax advantages to it, the primary one being depreciation deductions. So even though the value of your real estate's going up, you get to pretend it's not and take a deduction for that. The problem can be, though, is you're supposed to recapture that. You got to pay it back someday. However, the strategy we're going to talk about today not only can defer that, but potentially eliminate it permanently from income tax. So that's going to be a really important piece that we're going to cover today.
That's awesome. So one of the things that you said that I'd like to talk more about, too, is how a lot of stockbrokers or people that are traditional wealth managers will talk about buying stocks and bonds over real estate. And part of that is they have their own vested self-interest, right?
Oh, yeah. Well, you nailed it there. They don't get paid if you buy real estate. So I think you need stocks. I call it the yellow L-shaped widget. If that's all I have to sell, I think you need a yellow L-shaped widget. So if I sell stocks and bonds, I think you need stocks and bonds. And so I do it all. So whether it's passive real estate, stocks, bonds, annuities, I'm pretty agnostic as to what people put it in. But another interesting thing about real estate is the leverage factor. I mean, I own real estate. I own my office building in Everett. I've bought rentals over the years, houses, and I kind of brag about this. I've done it all with zero down. I've never had a dime of my own money.
Nice.
So I didn't have any money starting out, but you can get into real estate and use leverage to your advantage because especially now with interest rates so low, it can be a really super way to leverage and get ahead quicker in life.
Right. So when you talk about depreciation from a real estate perspective, that's considered not a cash expense.
Right,
just a
right. You get to
deduction.
take a deduction on your tax return that you didn't have to shell out any money for, and you get to do that every year. So that can really help you in the early years when you're trying to build your real estate empire and so forth, having less taxes and the leverage factor I just mentioned can be really important components to building that up.
Nice. Awesome. All right. I think that kind of takes care of that one. We'll move on to other investing strategies with real estate and how it relates to tax savings. So kind of going into question two, can you talk about how opportunity zones work as it relates to real estate?
Yeah, with opportunity zones, that came out with the new tax law, and there's been a lot of hype about it. It's going to be kind of a difficult thing, though, I think, for people to get into. Now, with real estate, they've come to me and said, well, should I sell my real estate and put it in an opportunity zone? I said, well, unfortunately, any investments into an opportunity zone, you're going to pay the income tax on whatever you just sold. You just get to put it off 7 years. And in 7 years, you're going to have to come up with that dough at whatever the rates are at that time. They might be higher. Now, it's the reinvestment, that whatever you put your money into, if that goes up in value, then you don't have any capital gains tax on that in the future.
I see.
But one of the problems with that, again, is I've got to find somebody, and you can only invest gains in it. So if you sell real estate, you can just put the gain part in.
I see.
You sell a business or stock, only the gain part. So you have to have a big gain. You're going to pay the tax on what you just gained in 7 years, and you're going to be illiquid for at least 10 years. I don't know a lot of people that are going to say, I have this huge gain, I don't need to touch my money for 10 to 20 years, and I want to put it into some opportunity zone project. So a lot of hype on it, but I don't know that it's going to really affect a lot of people, as opposed to what we're going to be talking about later that I'm doing a ton of.
Okay. That's cool. We'll get to that. Is there anything that's kind of changed with the new tax law, the Trump tax cuts, and as it relates to real estate?
Oh yeah, one of the big things is the QBI deduction, qualified business interest deduction. It was a 20% reduction of taxable income for most businesses, but they also included real estate as a business. So landlords, people that own rentals, they get 20% of their taxable income is not taxable under the new tax law. So that's been a big thing, whether it's REITs or DSTs or just your own rental holdings, you get treated just like any other business person would have, similar to the corporate tax cut that went in. They applied it to landlords.
Wow, that's amazing. That's cool. Very cool. Are there any other things that people can write off in real estate investment in terms of expenses for a tax saving perspective?
Yeah, pretty much every expense. I mean, if it's related to your rental in some way, shape, or form, write it off, in my opinion, because, for instance, your mileage back and forth, you can write off the mileage, your standard rates you can use for that. So keep track of all the expenses because they all add up over time. So, yeah, pretty much everything. There's no limitations on interest or property taxes either. I mean, most people have, the SALT deduction limitation, sales tax, and real estate tax and so forth. How Californians and New Yorkers got nailed on that. There's no limitation because your rental property is treated like a business, and all business expenses are deductible. They don't have ceilings like we do when we try to itemize our deductions on our tax return. Our principal residence, we get capped on the amount of interest we can deduct.
Right.
We might get capped on the taxes, but if it's a rental, there is no ceiling, so you can deduct anything on those.
Oh, that's cool. Actually didn't know that I knew the primary residence you had a cap on interest, but I didn't know that for rentals you don't. That's cool. Awesome. Well, that kind of takes care of that question. Let's move on. So can you discuss more about how a 1031 tax deferred exchange works and why it's an amazing opportunity for real estate investors?
Yeah, it's been around in the code for 98 years. Came in 1921. And yeah, it allows you to sell, they call it like-kind exchange, but like-kind is a bad term for it. It is not like-kind. It's any investment real estate you can sell and defer the tax if you buy other investment real estate and follow their specific rules. So for instance, you could sell a rental house, apartment building, a strip mall, office building, raw land, a farm, a winery, a mineral lease, leased real estate, and actually defer the tax through 1031 exchange. You have certain rules. You have 45 days to identify the new property, 180 days to close, and it has to go through what's called a qualified intermediary. And so there's specific rules and timing. But yeah, you can do a 1031 exchange, get out of whatever you're in, and buy other real estate and not have to pay all the income tax when you do it.
Mm. So you're basically deferring what tax you owe on the capital gains until you sell the other building eventually that you exchange
Well,
into.
unless you get to what's called the step-up in basis. So here's most of my clients that own investment real estate are baby boomers, and they're in their 60s and 70s and 80s. That's primarily most people that have big gains in their real estate. They've owned it for a long time.
Sure.
And so their plan is, let's say you paid $500,000 for something and it's worth $1 million. You probably depreciated it down to nothing. And so if they sell it, they have a $2 million gain. $500,000 of that is the depreciation recapture, and the other $1.5 million is capital gains. And so 2 different tax rates there. Well, if they keep doing 1031 exchanges in the state of Washington, we're one of 9 community property states that get a double step-up in basis. And what that means is that when either the husband or wife passes away, that $2 million gain, the $1.5 million capital gain, and the $500,000 depreciation recapture that was sitting there waiting to be taxed, is eliminated permanently. Nobody ever pays any tax on any of that. And so for legacy planning, whether it's to your spouse or your kids or your charities, whatever you want, you can just keep doing 1031 exchanges until you pass away. But then, again, most people don't want to be landlords their whole life, so we have a solution for that.
Nice. As far as a 1031 exchange goes, there's such a thing as like a reverse exchange, correct?
Yeah, there's reverse exchanges. There's also 1033 exchanges, involuntary conversions. So Sound Transit takes your property, gives you a check. You go, well, I didn't want to sell it. You didn't give me enough money. And then your tax guy says, oh, by the way, you also owe taxes on that property you didn't want to sell. Well, we can get you out of that tax, too, doing Delaware Statutory Trust, which we'll be chatting about.
Okay. Very cool. As far as the 1031 exchange, I've looked into this myself for some of my clients, and a couple questions that come up are, it's best if you're not going to identify more than 3 properties on the list for the 45-day identification period because of the 200% rule, right? Is that?
Yeah, there's specific rules for this. You can't list more than 3 properties unless it's under 200% of the sales price. There's it's probably beyond the scope of this discussion. Lots of rules related to that. You can do workarounds if you do it early enough in the 45-day period where we don't have to worry about that rule. And generally, that's what I do with my properties, so we can have Delaware Statutory Trust investments with multiple properties in them, way more than 3, because we know we're going to close before the 45 days is even up. So there are things that we would do to work around that. Lots of rules related to 1031s, again, probably beyond the scope of this, but just know that you have a resource, of course.
Okay. And then one more thing I wanted to comment on about 1031 exchanges. The qualified intermediary basically is somebody that can't be related to you or is a part of your own business, accountant, for instance, or whatever. But they basically hold the funds from the sale of the first property, and you don't have access to those as the investor. And then they end up buying the new property with the funds.
Yeah, so basically if you have you want to do this and you list your property for sale, that's the first thing you do. Prior to closing, you have to hire what's called a qualified intermediary. There's companies that do this, and they'll receive the funds at closing because you can't, otherwise you blow up the 1031 exchange. they'll receive the funds, and then they're waiting for direction as to how you want to invest them. And then generally, prior to closing, my clients would call me and then say, all right, pick out a property for me, if they don't have their own that they've already selected.
Right.
Because you can go out and buy a replacement property, or you can be a passive real estate investor and engage us to help you do that. But then, so you sell your property just like normal, money goes to a qualified intermediary, and then we select the replacement properties. That money goes there, they purchase it on your behalf, and off you go. You're still own real estate, you didn't pay any income taxes, you still get monthly rent checks, but the type of property you replaced it with either, again, is something you picked out yourself and bought, or something that has gone through our offices.
Okay. One last question on 1031s. Is there an opportunity to actually combine a 1031 exchange with an opportunity zone in order to not have to pay that capital gains that you maybe reinvested into an opportunity zone?
Yeah, you probably wouldn't use it with opportunity zone, but one of the areas that I see is maybe it's a mixed use. It's part personal residence. It could be a duplex.
Mm-hmm.
So half of it you're going to sell and claim the up to $500,000 for married exclusion. That's the best one. You get $500,000 of gain that you can have with zero tax. So if it's your principal residence.
Right.
Whereas the other half is an investment property, and so you might combine those. Sometimes it comes into play where you have a house on 20 acres, but they want to develop it and build a subdivision there. So you can split that investment. You say, well, I'm going to claim up to $500,000 on my house, but the rest of it I want DST and do it that way. So there's some creative things you can do with DSTs.
That's cool. Awesome. Well, we're getting closer to the actual investment vehicle. Like you've heard him say, it's called a DST, but we'll talk about that more coming up. Let's go on to our next question. Can you talk a little bit about how an investment company structure can determine your tax liability as a real estate investor?
Yeah, be very careful about putting it into a C-corp. You don't really want to use a C-corp for really much of anything because they have a double tax. So if a C-corp owns real estate and sells that real estate, it's going to pay a tax, corporate tax. And then as the owner, you say, oh, I want my money out of my corporation. Well, guess what? That's a dividend distribution, and you're going to pay tax again. There's two taxes on it. So you want to have a pass-through. If you're going to have an entity, you want to have it be a pass-through entity where there's only one tax. It's your personal tax. And it's just a reporting entity. So think S-corps, LLCs. They're just reporting entities. They don't pay income tax on their gains. It gets passed through to you as the individual investor.
Okay.
And so you might want to set up, I often see real estate set up an LLC just for that extra liability protection. From that, I would also encourage anybody that has investment real estate to buy a good umbrella insurance policy. So if you really want to cover yourself, put it under an LLC with an umbrella insurance policy. That's probably the best answer for that.
And so if you have an LLC for investing in real estate with an umbrella policy, but you want to be, isn't it a smart thing to do to be taxed as an S-corp for a pass-through entity so that you don't have to pay on the profits, you don't have to pay 100% of the profits of being 15% FICA or self-employment
tax? Yeah, so you're talking about the self-employment tax. Yeah, if I have a business that wants to set up, I often tell them to set it up as an LLC and elect S-corp status for income tax filing purposes only. And so for your real estate company in business or any of your businesses, that's exactly what I would do. But on rental real estate, investment real estate income is not subject to the self-employment tax unless that's your business, your trade or business.
I see.
So if you're just a casual investor, you're not going to be subject to that, but you're spot on. If you are going to be subject to that, you want to elect S-corp status to play that Social Security game. Because if you don't do it that way, 100% of your business income is going to have the Social Security and Medicare tax times 2.
Okay. So part of back to what you were saying, having it be your full-time business, that would be considered like a real estate professional by the IRS, correct?
That's right.
And you don't actually have to have a license, like a real estate license, to be considered a real estate professional, only that you're spending your full amount of work time in real estate investing activities.
Yeah, there are advantages to being a casual real estate investor versus that's your trade or business. Trade or business tax rates are higher than capital gains rates, and so the same person could sell two brothers could sell the same property that's next door to each other, and one has one tax rate, one has another because of what they do for a living.
Mm. So is there any benefit to being a real estate professional as it relates to taxes?
You get deductions and so forth. You're going to have that, but really, it's not that you get to pick. There's rules about what is considered to be that. Understand the tax code is actually quite small compared to the interpretations of it. The interpretations is like 2 million pages, and so it is very gray. There is very little black and white. When they write a tax law, they basically draw a stick figure, and they tell everybody, the tax courts and everybody, fill in the meat later. We're just giving you the stick figure, and it's kind of up to interpretation.
So I've heard that if you're a real estate professional and your spouse maybe works a full-time job, you can actually write off some of your passive losses like depreciation against some of the income earned by your spouse that's not in real estate. Is that true?
Yeah, there's all kinds of, I own a CPA firm. We do about 3,000 tax returns a year. There's a reason people pay us to do them because it's very, very complex. And there's, I almost can't even answer it. I can answer investment questions. I can't answer a tax question because, well, it depends.
Yeah.
Well, it depends. That's the problem with the tax code. It's gotten so complex. And then you can give 10 different CPAs, same set of criteria, and you're going to get 10 different tax liabilities. It's an art, not a science.
Yeah, that makes sense. Well, I guess we'll move on to the next question here. So we're going to actually move now more into the estate planning and retirement planning. So from the first question in this category, what are the common mistakes that people make when planning for retirement?
Yeah, the first one I would say is just not doing it. Most people don't. They just kind of wake up one day and go, I think I'm going to retire. I wonder if I should maybe start thinking about what I should do with my money. It's never too late to start.
Right.
But putting it off, procrastinating, spending more time picking out your next vacation than you do with your retirement planning or that kind of thing. And the do-it-yourselfer. I mean, one of my books, I talk about the $1 million lawnmower, or it was a $2 million lawnmower. The guy didn't want to hire an attorney; it would have cost him $1,000. He said, "Well, I was able to buy a lawnmower though with my $1,000." Well, he didn't put a paragraph in his will, credit shelter trust provision paragraph doubling his taxable estate, and that cost his estate $2 million. So I call it a $2 million lawnmower. And so there's just, just in this little talk here, I'm sure anybody listening is going, there's a few things I don't know. This guy seems to know. Well, yeah, of course. And so if you find somebody very competent to help you with that, you can do huge things for yourself and your legacy and your spouse and your family. Knowledge is king. So having that information, getting some help, I think is really, absolutely imperative.
Yeah, I think one of the things that I've come across in terms of looking at people and the lack of planning for retirement, and correct me if I'm wrong on this, but is that a lot of people think that when they look at when they want to draw Social Security, they think that they're not going to be able to spend all the money that's owed to them, when in reality the greater risk is outliving your money, right, in retirement, because you actually live longer. And medicine's obviously a new, it's changing every day, but it's always getting better, so people's lifespans are better.
Yeah, I mean, we run a Social Security optimization report, but that's also an art. I have to know what you think your lifespan is going to be. What's your family history? What's your health like? How about your spouse? Who is a higher earner? You might have somebody wait because they were the higher earner and they're going to pass away first, we think. You might have them wait until age 70. But other people, I would recommend maybe starting it earlier so you have more money in your 60s and your 80s. So it's not just the amount of money, it's the quality of your lifestyle when you're getting that money. So right. I might suggest, well, why don't we take that early, but other cash flow, like from real estate or DSTs, which we keep hinting at here, can be cash flow for life, certain annuities. So there's all kinds of different ways you might want to get that cash flow, because that's what you want in retirement, is more security and cash flow. Pre-retirement, you want more growth and liquidity.
Right.
And so, that comes into play.
Nice. As for those people who are counting on Social Security to be a big portion of their monthly income, it obviously pays to actually delay it as long as possible, right? Because you can grow.
It does, but the issue can be if that is, pretty much all you have, and somebody says, well, I retired at 65, I'm going to wait to be 70 before I start it. I'm going to eat a whole lot of top ramen for 5 years, it sounds like. I mean, you do have to eat. So if that's your only source of income, looks to me like you got to start it when you retire.
Right.
So there are some life parts to this you have to factor in.
Right. And then you can get creative with like IRAs and taking distributions for 401ks and things like that.
Oh yeah. And the more different buckets you had invested over time, the better it can be. You have options, and that's why it's good to start financial planning early rather than putting it off.
Right. Awesome. We'll go on to the next question. What should future retirees be doing now with money management in order to prepare for retirement?
Yeah, understand that there's a lot more out there than just stocks and bonds. As we talked earlier, that you do want those different buckets, as I mentioned. I love having real estate in an investment portfolio. I'm not a big fan of bonds right now. In fact, a third of the global 10-year bond market currently, as we record this, is negative yielding. I'd rather find a hole to put my money in than lose money on purpose, buying a bond. So there's a lot of better alternatives out there. So just understanding that you have a lot more than your Edward Jones retail person would put you into, that understand they're paid to sell you stock and bond funds. But there's so many good opportunities out there, and frankly, investing in yourself is the best one. That's your best investment. Your education, your career path, your business, that kind of thing. Rate of return is going to be much higher than I'm going to get on anything coming to my office. I'm investing people's money after they've made their money in their business or profession or real estate, the two areas we talked about. And so it's a secondary kind of thing where you want a little bit more security, perhaps.
Do you think a lot of people miscalculate what they need in retirement because of lack of planning for inflation and
how long they're going to live? Yeah, I mean, with the financial plans we run, and if somebody has $500,000 of investable assets, we run them for free. But we have we have everything built in. We have increasing spending built in, increased income taxes at age 70 and a half due to required minimum distributions. We have that factored in. We have it all in there. Inflationary features, increases in Social Security, we limit because we don't think they're going to be very good. So there's a lot of assumptions, and I've seen some plans cross my desk, and other advisors, frankly, that want to get a client. They say, "Oh, look, you're going to make 8% a year with no fees and no taxes," and everybody comes out looking like they're going to have $20 million. You're a teacher and you work for the post office. I don't think you're going to have $20 million. I think that the assumptions in this plan are horrid. They're terrible. I don't even know where they get some of these numbers. So you want to do the plan with some conservative assumptions, not rosy ones.
Right. Definitely agree there. All right, we'll move on. Question 7, as it relates to estate planning, what do you recommend families do in order to protect their assets?
Yeah, if you have a larger estate, you can get really creative. I just had another article published in Kiplinger called Tax-Free Investment Strategies. And we worked on this one big case. They owned a lot of real estate in Seattle. They sold it. They did the 1031 exchange. And he was worried about tax rates going up in the future. They listened to the candidates. There's some that want to do the 95% bracket. We've had 94% in this country.
Yeah. What year was that?
That was World War II. And the Beatles sang around about the 95% bracket. There's one for you, 19 for me, because I'm the tax man, was their tax protest song. And so that's how I started my article, talking about that. But we're going to use a product that's going to shelter irrevocable life insurance trust. We're using annual gifting to accomplish getting money out of their estate. It's going to grow income tax free in this trust. It's permanently excluded from their estate. There's all kinds of cool vehicles, but you kind of have to be an estate. You have to be an estate planner to maybe have access to all of that. Not a lot of those folks out there. We are one, so certainly we can help with that. But there can be gifting. You can take advantage of minority discounts, setting up family LLCs. there's just, way beyond, again, this, I don't have enough time to go into all
Sure,
I could talk about there, but there is some really good stuff, and it can save, literally, I mean, we're talking just on his 1031 exchange, this person saved $6 million, and then we're talking about transferring $40 million down the road to his heirs, estate and income tax free. Yeah, no, that's some big stuff that's out there if they know what they're doing.
Wow, that's amazing. So it might be, obviously, one size doesn't fit all, depends on the family and what kind of assets are there. But
it could be as simple as one of my chapters in my book says called "Grandma, Please Don't Give Me Your House," and that's just a step up in basis. If your grandma gives you your house and you sell it, you got to pay tax on all of it because it was all gain. She bought it a long time ago. If you wait to inherit it, you get to step up in basis. You sell it, there's no income tax. Just a simple little thing like that. Grandma, don't give me your house. I'll inherit that instead.
That's interesting. That's cool. So in some cases, it might make sense for a family to just work with a will, and if their asset level is below a certain amount, versus actually setting up a trust. Would you agree with that?
Yeah, a lot of people in the state of Washington, if you have a will as opposed to a living trust, probate isn't as onerous here or as expensive as other states. If we were in California, I'm going to say do a living trust for sure. Different attorneys have different thoughts on that. Sometimes, living trust might pass assets more easily than a will because you don't have to go through probate.
Right.
If you've retitled everything, which not everybody has. Just because you have a living trust doesn't mean you're not going through probate. You got to keep up on that. And so, but for most people, probably listening to this right now, a will probably is adequate. But that is something you want to talk about with your person drafting the will or living trust.
Sure. Yeah. Okay, makes sense. Go on. Can you tell us a little bit about the best times for retirees to take Social Security? I know we kind of briefly mentioned this, but what are some of the common misconceptions around Social Security withdrawal?
Yeah, well, most people take it too early sometimes because certainly if you take it before your full retirement age, you really can't have a decent paying job. Otherwise, you got to give that money back, and you've just given up your raises. So up until retirement, you get an 8% lifetime raise, but you have one less year, per year.
Right.
But you have 1 year less year, 12 less checks because you waited a year.
Right.
And after full retirement age, it's 6.5%. Your break-even point is about age 80. So if you take Social Security early at, say, 62 and you're not working, well, you get 8 years of checks, 96 more checks, but they're small. And versus had you waited till 70, you get much bigger checks, but they're going to have a crossover at about age 80. So if you live longer than 80, you'll have more money had you waited.
Yeah.
However, you had to put it off, so that's where we have to look at your other income sources, make sure that's okay. One of the things, again, is if you have a spouse and you think you're going to pass away first, I would want to wait because if I was the husband, I passed away first, then she would get my Social Security number figure for the rest of her life. Had I waited, that's a bigger number.
I see.
And if she outlives me by a long ways, that could be a big benefit to her. So there's some other things to consider.
And a lot of people probably don't know this, but some of your Social Security can actually be taxable, right?
Oh yeah, up to 85% of it can be taxable. So that is, I don't know why they did 85. I know they're going to go to 100 at some point, but it's 85 right now.
Interesting. Crazy. All right, well, we'll move on. Do you have much experience helping families in probate or helping them manage an inheritance once they receive proceeds?
Oh yeah, I do this a lot. In fact, I definitely want to get involved because I've even seen a lot of CPAs miss the step up in basis. And I remember this one new client came in. He had the family there. They were there, and CPA was there. Investment advisors there. Everybody's in the room, and they wanted my opinion. I said, "Your wife passed away last year?" He said, "Yeah, but we have all these taxes. We're gonna, yeah. Ever heard of the step up in basis?" And they're like, "Huh? What's that?" And the meeting was pointless. I said, "You can sell everything he has. You have no tax." Because the market had gone down since her date of death. They actually would have a refund.
Oh, wow.
So I was like, well, this is a short meeting. Glad the 10 of you could attend, but, And so, but yeah, I'm always helping people and planning ahead because often people say, oh, I'm going to leave my real estate to my kids to manage. I want to pass it on. I'm like, oh, what kids you got? And they say 3. And how do they get along? Well, the younger one thinks the older brother's an idiot, and the sister wants to sell it, and they want to manage it, but they don't think so you're just going to have trouble.
Right.
And so we say, why don't we be smart, knowing what we know now, and fix it so we aren't going to have these kinds of problems down the road. So a lot of planning goes around just family dynamics, if nothing else.
That's good. Awesome. Okay. And this is, I think, the last question, and we'll go into the investment vehicle you've been talking about. So do you know what kind of estate taxes need to be paid in the case of probate, or how about if there's a living trust?
Yeah, one of the interesting things people don't know about is they inherit money. They think they ought to pay tax on that. Absolutely not. Any estate tax is paid by the estate before you inherited the money. You're getting the net proceeds. Federally, you can have $11-12 million before there's any estate tax. If there's a married couple, you can double that if you have that paragraph in the will or living trust. In the state of Washington, it's closer to the low 2.3 million, call it, that you can die without estate tax, or 4.6 if you have that paragraph. But you can do gifting if you want to get rid of that. Let's say you're in that $7, $8, $9 million whatever net worth. You can do gifting. There's lots of things you can do to get that down. So it doesn't matter whether you have a will or living trust. What matters is that you have the provisions set up to double that estate tax exemption. So a lot of people don't pay federal estate tax. They might pay some state because of the $2.3 million per person. There is, if you inherit money, you get the step up in basis. If you inherit a house or stocks or anything, you don't pay tax on that because the basis is stepped up. But if you inherit retirement funds or annuities, you will pay income tax on those.
I see. So in the terms of gifting, there's limitations per year that someone can gift a portion of their estate, right?
There is limitations, $15,000 a year per person. So if a married couple had 2 kids, they could each give $15,000 to each kid. So that's $30,000 per kid. However, let's say they give $130,000. You say, oh, don't they owe tax on that extra 100? No, that 100,000 just eats into that, let's call it $12 million federal exemption. Now you can only give away or have them inherit $11.9 million. Well, big deal. You're supposed to fill out a tax return saying I chipped away at my lifetime exclusion. You're supposed to file a tax return just saying that. But no big deal. You're still not going to pay any tax. So you can give away as much as you want. You just may have to fill out a tax return to say so.
Got it. Wow. Very creative on how you can set everything up, I'm sure. All right, so now we'll kind of move into what we've been talking about and alluding to. So can you tell us how landlords can retire from being a landlord without giving up the passive income that they're making and have kind of headache-free retirement with no property management required?
Yeah. In 2004, the IRS passed regulation, 2004-86, that created something called the Delaware Statutory Trust, DST. And that allowed people to do a 1031 exchange, sell their real estate, and invest in passive real estate and still have it qualify. So, it doesn't really help if you say, well, gosh, I'm getting up in age. I don't want to do this anymore. I'm going to sell my apartment building. Then I have to buy another apartment building? Well, what did that fix? Nothing. Yeah. What are you going to do? Buy a piece of raw land? It doesn't pay any income. You're going to buy a bunch of rental houses. You got to be a landlord. You don't want to be a landlord anymore. So that's always been a problem until this opportunity came along. So passive real estate. So now you can sell your real estate, whether, again, rental houses, apartment buildings, farms, land, whatever. You can sell your investment real estate and reinvest that money into passive real estate, where you have an institutional real estate investment company managing real estate for you. So let's say that somebody sold $1 million property and they were going to owe $200,000 in income tax, and they don't want to ever pay that. So they sell their property like normal. They do a 1031 exchange, and then I might invest them into the different Delaware Statutory Trust properties. It could be apartment buildings in let's say Texas and Florida, the Sun Belt states. It could be self-storage. It could be triple net lease, corporate guaranteed Walgreen and Advanced Auto Parts, Dollar General stores, that kind of thing. It could be healthcare facilities, industrial parks, Amazon leases, anything like that. So they rotate. There's always some inventory, but as soon as they fill up, they're gone. But I'll diversify a client into different ones. As soon as they invest in those, they own directly a slice of the pie of each of those pieces of real estate. They get their rents that next month, so they still get their rental income. They still can have the underlying appreciation. They can never get a phone call saying, hey, we need to replace the roof. It's not allowed with DSTs. They've already put money away in reserves for those kinds of things. They don't have to be a landlord anymore. They're better diversified. They're diversified in different property types, different parts of the country, generally much newer properties than the one that they sold. Much newer. A lot of them are relatively brand new. And so, and they still can get the step up in basis someday for their spouse or heirs, so that no income tax, capital gains, or depreciation will ever be paid on. So a lot of benefits potentially for a DST.
Wow. So it sounds like it's very similar to a REIT or how a REIT operates, but correct me if I'm wrong, the difference here being that you can actually 1031 exchange your property into a Delaware statutory trust, and you can't into a REIT.
That's absolutely correct. You cannot do a 1031 exchange into a LLC or partnership or an S-corp or a REIT or anything. The only way you can do it is through what's called a Delaware statutory trust. So real estate investment companies go out and they purchase these properties. They get them all leased up, all fixed up. They're ready to go. They're operating. They know exactly what the rents are. Then they package them as a DST and let me know, hey, we've got $40 million of equity available. So as soon as we get our $40 million back, we'll close it to new investors. So I know I've got maybe 2 weeks to a month to have investors go into that particular property if I want it, if I vetted that through. And so they'll collect their money, close it to new investors. They'll hold it between 4 to 10 years, and they'll sell it. When they sell it, you get your share of the appreciation. You've gotten your rent all along the way. They'll let you know ahead of time, so you can either take the money and pay the tax, take the money and not pay the tax because there's been a death in the ownership. You can go out and buy a rental house if you want. If you want to get back into the game, you're bored. You want to get back to being a landlord. But most often people just keep doing DSTs until somebody passes away, so they just keep swapping.
I see. Interesting. That's awesome. So can you explain like what it's like from a depreciation recapture standpoint?
Yeah, so sometimes if you have a property that's fully paid for, you can actually increase your new depreciation on this new DST. So I've seen situations where, let's say your cash flow is $50,000 a year. When they do their tax returns after taking the new depreciation and that qualified business interest deduction, the 20%, their taxable income is less than half of their cash flow.
Wow.
So they get some really, and they never have to pay back that new depreciation if they hold it the rest of their lives.
Wow.
So that gets stepped up too, along with their old depreciation and all capital gains. So there are a lot of advantages. I did want to touch on why somebody would not do a DST. There's no perfect thing out there. If you're young and a good developer in real estate, and that's kind of where you are getting rich, this is not a get-rich strategy. It's a stay-rich strategy. It's a retirement strategy for landlords. But if you're making your fortune out there doing real estate, keep doing that. Yeah. You do this when you don't want to be in real estate anymore as an operator, as a landlord. So it's that. And the other reason would be liquidity. If you needed all your money in 2 years to buy an emergency Ferrari or something, you can't call them up and sell it. They're not really liquid. They're going to tell you when it's selling between years 4 and 10.
And so you partner with what you call sponsors, right, to
Yes.
be able to put these people's money from the sale of their previous property into property fund, essentially.
Right. There's 30 or 40 sponsors out there. We vetted them we'll work with 6 of them. And so when they come out with new offerings, we vet the offerings in at that point too to determine whether we think it's a good one, a really good one, a not so good one, and then we'll treat it accordingly for our clients.
So very few people I've heard actually talk about this investment vehicle, so it's probably not very well known in investment planning and retiring and
Right.
planning and things of that nature. And you, correct me if I'm wrong, but you actually go around training people about how to do this, right?
Yeah, I was hired as a national coach to hundreds of financial advisor owners of their own companies because they've never heard of it, and they can run their business through my office. I've got 30 employees. I got people that can do that stuff, and I've written a book on it and multiple Kiplinger articles and a white paper and blah blah blah. Lots. I've done a lot of research on this area. I think that the issue is you have to go through a financial advisor to get into one. Most financial advisors are not very equipped to talk income taxes because you have to be a CPA, and most financial advisors don't like real estate because they never got paid on it before, so they don't know anything about it.
Sure.
So if I'm talking to a real estate person, I better understand cap rates and types of property and why one would be better in a recession than another and what's going to happen in different parts of the country, demographics, all kinds of stuff. I have to know this real estate inside out and sideways, which we do, and so it can be because we bring the CPA world with the financial planning world with the real estate together. That's why we can offer these. But yeah, most people out there have no idea. CPAs don't know what they are. Financial advisors that can sell them don't know what they are. So yeah, there's a real lack of information about them out there.
Wow. So you'll probably see a lot more of these popping up in terms of an investment vehicle for many people if they're.
I don't know. I don't think so. I
No?
think that it's too deep of a dive. It's like somebody that sells stocks and bonds becoming an estate planner. Well, all you got to do is get a CPA and you really understand the tax code. Well, that sounds a little hard. And they start hearing about the DSTs, and even when I'm coaching them, would you like to learn more? No. Can I just put my clients on the phone with you? You tell them answer all their questions from them and their CPA and family members. You guys handle all the paperwork and do all the vetting of all the real estate. I'll just put them in a chair and get them on the phone. And we say, all right, that sounds great. They don't even want to do this stuff.
Wow.
It's too deep of a dive for them to get to that point. So I don't think you're going to see a lot of other people offering them.
Interesting. That's good to know. Well, that kind of pretty much sums up today's interview. But as you can see, guys, it's really important to hire the right professional. We could be talking, hours on end, let alone more than one day, about real estate investing, but also retirement planning and also estate planning. So make sure you hire the right individual. It's been a great pleasure having you on this this segment. And if any of you guys need help with financial planning or retirement planning or estate planning, hit up Brian or give me a call for anything real estate related as well. Once again, my name is Josiah Willis. This is Brian Evans from Madrona Financial Services. And thanks again for watching, and give us a shout out or a call if you have any questions. Appreciate you being on the show.
You're welcome.